In this video, we continue our discussion on Chapter 8, in which we discuss equilibrium, where in our last video we went over the profit maximization process for a competitive firm, where in this video we seek to make additional notes about a competitive firm's profit maximization process by considering some preliminaries in order to go over product supply, product demand, as well as market equilibrium for a perfectly competitive market structure. So to begin with our preliminaries, recall that our example was a competitive farm that is growing crops with a fixed amount of capital and a variable amount of labor, where we have their production function below in terms of their variable amount of labor used and fixed capital in order to produce a certain quantity of crops. And we also have their profit maximization process below as well, where we have their horizontal marginal revenue curve and their upward sloping marginal cost curve as well, where overall we observed that the firm is a price taker and that there's many farms in this marketplace growing an identical crop such that no individual farm has market power over the price of crops, and that in the profit maximizing process, the competitive farm in this case, when deciding on how much variable input to use to produce an additional amount of crops, they will compare marginal revenue to marginal cost. That is, to produce one more unit of a crop, they will compare additional amounts of money coming in versus additional amounts of money flowing out of the company. Or overall, in terms of their decision, in terms of choosing variable amounts of labor to get their profit maximizing output level, they will decide upon when marginal revenue is equal to marginal cost. That is, the amount of money flowing in versus the amount of money flowing out based off of this additional production decision is neutral, where when marginal revenue is equal to marginal cost, this will give us the price point as well as output level that maximizes profits, in which we can calculate profits as we did in the prior video, but we can also back this out and also determine the output level in the production function, which also gives us our variable amount of labor that is used as well. Some additional things that we can note though with this profit maximization problem is that the marginal cost curve turns out to be the short-run product supply curve for a single competitive firm. Additionally, the marginal revenue curve is the product demand curve for a single competitive firm as well. And lastly, that price is equal to marginal revenue, which is equal to marginal cost, is the equilibrium price and quantity level for a single firm. So, in order to look further that the marginal cost curve is the short-run product supply curve for a firm, let us first recall some things on product supply, where first, defining product supply once more, it's the ability and willingness to sell and produce specific quantities of a good at alternative prices in a given time period, holding all else equal. And in regards to our primary property of product supply, we turn to the law of supply, that is, the quantity of a good supplied in a given time period increases as its price increases, given no other changes. That is, there's a positive relationship between the price of a good and quantity supplied of a good. And in terms of our non-price determinants of product supply, we have our 7 in the form of technology, factor costs, price of substitute goods that the firm is producing, price expectations of the good that's being produced, taxes paid to the government, subsidies received by the government, as well as the quantity of firms operating in that market space. So what we'd like to do with our marginal cost curve is verify that the law of supply holds, and that if there is a change in a non-price determinant of product supply, we will see a corresponding change in product supply that is a shift left or rightwards in the marginal cost curve. Beginning with verifying our law of supply, observe in our profit maximizing problem where here we have this below that cost is on the vertical axis, quantity of crops is on the horizontal axis. We have our horizontal marginal revenue curve corresponding to our price determined in the market of $10. We also have our upward sloping marginal cost curve, and that intersection gives us the optimal amount of output at the corresponding price rate in which this firm maximizes profits. Suppose that in the market price were to increase. This would then correspond to an upward shift in the marginal revenue curve. Let us see what happens to our output as a result. So with an increase in price, marginal revenue shifts upward from marginal revenue to marginal revenue 1 in this purple curve, in which the price point is now $15, with an increase in the price point of this good corresponding to an increase in marginal revenue, this leads to a new intersection in marginal cost in which we see that there's a higher amount of crops being produced than when we intersected marginal revenue in green with the marginal cost curve. So here we have an increase in price corresponds to an increase in quantity produced. Now for the second case, now suppose that the price of crops in the marketplace declines, such that marginal revenue for an individual firm declines. Here we have marginal revenue in green shifting down to this purple curve marginal revenue 2, in which the price point is now $5, in which it now intersects marginal cost at a lower output than before. Where here we have that with a price decrease, quantity produced decreases as well. So with both of these cases exhaustive, we've now verified that there is a positive relationship between price and quantity produced in terms of the marginal cost curve. So this verifies our law of supply. Now, let us move on to verifying changes in supply. So with our profit maximization process that we have below again, let us see that there's a change in a non-price determinant of product supply, such as an increase in fixed costs. Well, if there's an increase in fixed costs, it's more costly to produce goods and services. This should correspond to a leftward shift of the product supply curve, holding price constant. Well, here we have our original marginal revenue curve, and we have our original marginal cost curve. With fixed costs increasing, this then corresponds to a leftward shift in marginal cost, in which we now have this marginal cost curve 1 in purple, in which we see quantity produced and sold has declined, holding price constant, which verifies a change in product supply to the left. Now to see that a rightward shift also holds, let us now consider the secondary case in which we have a improvement in production technology, where with an improvement in production technology, we would expect a rightward shift in that it's easier to produce the good and service in question, holding the price of that good constant. Where we'll have precisely that, where holding our marginal revenue curve constant, and we have our initial marginal cost curve in black. With an improvement in production technology, we will see a rightward shift in a marginal cost curve to this purple marginal cost curve 2, in which we see holding price constant, the amount of output produced and sold has increased. So this then establishes a change in supply for the marginal cost curve as well. So then, verifying the law of supply as well as our change in supply as well, this establishes that the marginal cost curve is the short-run product supply curve for an individual competitive firm. Now, moving on to product demand, we observed that the marginal revenue curve is also equal to the price of our crops, which we established was at $10. So not only is marginal revenue equal to price, but it is the product demand curve for a single competitive firm. To see this, we once again have our profit maximization process below. Horizontal marginal revenue, upward sloping marginal cost curve. Their intersection gives us the optimal amount of output at the corresponding price point of $10. Now let us see this firm's pricing decisions. In case 1, if the firm decides to price above marginal revenue, no output will be sold. In that, if the market rate for this crop is $10 and they decide to increase their price to $11, since there's so many other firms in this marketplace selling an identical crop at $10, nobody's going to buy from this individual farm, but instead all the consumers will take their business to the other identical farms and purchase the crop at $10. So the firm has no incentive at pricing above this. Now, if the firm decides to price at marginal revenue, that is the price point that is established in the marketplace, output is exhaustive, and the firm is maximizing their profits, and we have that condition established here below. Marginal cost is equal to marginal revenue. Now, in our third case, if the firm decides to price below marginal revenue, that is somewhere below $10, the consumers will see this as beneficial as all the other farms are selling their crop at $10, and the current farm that we're considering that's pricing below $10 will sell all of their output, but there's the chance they'll be making a negative profit in that they could be doing better by selling it at a higher price point of $10, given that there will be a different intersection of price and marginal cost. So the firm would not be incentivized to do this, and they would want to raise their price and keep it at marginal revenue is equal to marginal cost. So In this instance, we have established that the horizontal marginal revenue curve is the product demand curve for a single firm. Now, if marginal revenue is equal to marginal cost is the equilibrium price and quantity for a single firm, then summing across the entire market, this will give us the product demand and product supply for the entire market. Where here on the left, we have the product demand and product supply curve for the entire crop market, where we have a downward sloping product demand curve representing our law of product demand, in that there's an inverse relationship between the price of a good and quantity demanded of a good. And we also have our upward sloping product supply curve indicating that positive relationship between the price of a good and quantity supplied of a good. And this product supply curve for the entire market will be the sum of all marginal cost curves of the farms in the market, and their intersection corresponds to the unique price point and quantity level in which there's no excess quantity demanded nor excess quantity supplied. And this particular price point that's established also determines the price point that an individual farm charges, and also doubles as the marginal revenue curve or product demand curve for an individual firm in the market. And if we also back out their individual marginal cost curve, we also have their product supply curve as well. So then with this information, we can then look at the equilibrium price and quantity level for an individual firm, as well as the equilibrium quantity level and price level for the entire market as a result. So then to recap that, where for an individual firm, we have that product demand is horizontal, since a firm in a competitive market is a price taker and they do not have market power. Product supply is upward sloping and is their marginal cost curve, where with respect to the entire market, product demand is downward sloping, reflecting the law of demand, and product supply is upward sloping and is the sum of all marginal cost curves for firms in the market. And the price in the market equilibrium determines the marginal revenue for a single firm. So with this in mind, where we'll pick up in our next video is examining profit calculations for a competitive firm, as well as the shutdown condition.